I think the biggest mistake that I've seen is investors go in here and they're expecting to get a girlfriend or boyfriend on the first date. That's just not how it works. Like, you're not going to close that funding round in one go, right? Like, you want to leave someone kind of, intrigued, wanting more and wanting to learn more. And I think the best thing that you can do in that scenario is ask questions about them, right? You're trying to get to know them. If they're just as good of a fit for you as if you are for them. And that is an incredible frame of thought. So I love what you were saying there. Jeff, anything to add?
No, I think, again, one of the key things is just, identifying the investors that are good fit for you up front. Matt kind of hit on that, and it's critical. I mean, I'll just speak from experience. When somebody knows the type of investments that I can participate in, or that I'm willing to participate in as an angel investor, it makes a big difference, as opposed to somebody just hitting me cold and saying, hey, we invest in my company. And then creating that personal relationship is something else that Matt kind of hit on. Was, you can get to know the investors in different ways, whether it's through LinkedIn and social media type things, or going to events. You kind of have to get out there as a founder, and fundraising's a tough job.
Amen. Amen to that. I see two questions in the Q&A. Jeff, do you want to pull those up for us if that's possible? Oh, I can't click on them for some reason.
Let's see, where are the questions? Oh, are they? Oh, gotcha, in the Q&A. Gotcha. Okay, so Anna says, what is the group's view on a current ratio of committed to deployed capital, 5-1, and what that means for deal making? VCs are sitting on a lot of cash. So yeah. I think what you're referring to is there. I mean, you hear all the time that there's a ton of dry powder out there that VCs are sitting on. I was kind of thinking the same thing. I mean, a couple of years ago, it was like tons of dry powder, and it just seemed like it was getting more and more. But if you really look at the overall, dynamics of the market, interest rates have probably had a bigger influence than anything, and just, some of the uncertainty around the markets over the last couple of years. And venture capital firms have pulled back. They haven't been investing as much. And the issue with dry powder is that it's not that they're not necessarily deploying it. It's getting put somewhere, but it's just getting put in different places than startups. And, that tends to be very cyclical. And so you'll see, I mean, we had a decrease in interest rates, just recently. And, I mean, that can have a big impact on the market. But I wouldn't put too much weight into all of this dry powder that you hear about all the time. Because if you think about it, when a VC has a bunch of dry powder, they've got existing portfolio companies. And a lot of times they're deploying that capital into shoring them up instead of going to new ones. And so don't think that just because there's a ton of capital out there that it's going to go to you, and it's all going to unleash at some point. With that said, I think there are some dynamics in the market where you have a lot of really good seed stage companies that have been kind of just extending their runway through, smaller rounds. And at some point, you're going to see a lot of Series A capital flow into the market because there's a lot of good companies out there that need that investment and that are worthy of investment. And so I think it's much more of a dynamic of that than just having a lot of capital out there that's available, because these investors, they'll find out where the best place is to put that money, even if it's in T-bills eventually.
Yeah, so Jeff, I think you nailed that, right? Like we're seeing the same thing. So basically it's all relating to interest rates right now. And like a data point that I pulled from your former company at Carta. The investment levels right now for startups is basically at like 2018 levels. And right, what's happened after COVID, right? Capital was cheap and was all going to startups, right? And now that dry powder, that 5-to-1 ratio that Anna was saying, it's being reserved for portfolio companies. And I've spoken to so many VCs, and the other thing that we're seeing is the VCs themselves are struggling to raise money from LPs, right? And the LPs themselves, it's all interest rate driven. So it's a healthy cycle. I'm kind of it's kind of a good thing if we just kept hyping up startups, right? It wouldn't be a sustainable investment channel, right? And we want to keep the integrity of basically startup financing and make sure only good, healthy startups get finance.